In the 1990s, a friend introduced me to the Darwin Awards. This was before websites, so it was an email that was circulated to a subscriber list. Based on the idea of natural selection, the Darwin Awards were given posthumously to people who exited the gene pool in creative and what after the fact appeared to be stupid ways. It made for laugh-out-loud reading. Here's a winner from 1990 called Wrong Time, Wrong Place, again as reported in February of 1990 from Washington. The following mind-boggling attempt at a crime spree appeared to be the robber's first try due to his lack of a previous record of violence and his terminally stupid choices as follows. 1. His target was H&J Leather and Firearms, a gun shop. 2. The shop was full of customers, firearms customers. 3. To enter the shop, the robber had to step around a marked police patrol car parked at the front door. 4. A uniformed officer was standing at the counter having coffee before work. You can see where this is going. Upon entering the premises, the would-be robber announced a holdup and fired a few wild shots. The officer and a clerk promptly returned fire, covered by several customers who also drew their guns, thereby removing the confused criminal from the gene pool. No one else was hurt. Good, right? At Foster Group, we have 5 principles for investor success. Construct plan-driven portfolios, embrace uncertainty, trust markets, advance with science, and today's topic, avoid predictable mistakes. We believe that investors increase their chances of success by avoiding predictable mistakes. Those practices that sound like they should work, but have been shown time and again to have very low probabilities of success, and generally result in harm to the portfolio and the investor. Dimensional Fund Advisors updates a study every year called the Fund Landscape. In that study, a consistent finding is that on average, less than 1 in 5 top quartile performing funds or managers from one 5-year period will continue to rank in the top quartile of funds and managers during the following 5 years. The study reveals a lack of persistence among top performing funds and managers. If you are picking a fund or a manager based on past performance, the probability of getting it wrong is worse than 3 in 4, slightly above 75%, while the odds of getting it right, well, they're less than 1 in 4 or below 25%. Talk about past performance being no guarantee of future results. This is the kind of behavior our term predictable mistake comes from. In this case, the behavior of buying what has outperformed in the past shows a low statistical probability of success. It's more likely, it's more predictably going to fail rather than succeed. A very recent example of this one, also called performance chasing, which is just buying the fund with the most recent eye-popping return, has to do with a fund that rose to prominence in the pandemic, Cathie Wood's ARK Innovation ETF, ticker ARKK. This fund specialized, and still does today, in trying to pick digital technology disruptors early, like they did with the crypto exchange, Zoom, and a couple of biotech firms in 2019 and 2020. In the immediate recovery of the market in mid-2020, while still in the pandemic, these tech companies saw their shares rocket up in price. And so did the fund, which achieved one of the highest annual returns in history in 2020, 153%. Now that 153% return obviously got investors' attention. So much so that throughout 2020 and into 2021, the fund saw net inflows rocket along with the share price. A textbook example of performance chasing. Investors saw big returns and wanted to get in, thinking that they would continue, and maybe that Cathie Wood had figured out the market. The problem, no matter what you think of Cathie Wood's ability as a portfolio manager, was that those stocks that shot up in 2020 and early 2021, well, they began to fall and then fall dramatically more than the market in 2022. In a Morningstar study in May of 2023, the author estimated that though the fund showed a reasonably good 9.5% annualized return over its lifespan, dating back to its 2014 inception date, the average investor in the fund experienced a loss of more than 25%. Ouch. Most investor dollars bought shares after the big price increases and then held them as the share price declined. Performance chasing can indeed be hazardous to your wealth. Performance chasing is closely related to market timing, another strategy that has shown a very low probability of success. The market timing intuition is that an investor, especially a professional one, should know when to get out of stocks to avoid the losses and when to get back in them to capture the gains. This predictable mistake is attractive because of something called hindsight bias. After the fact, market drops and recoveries, well, the reasons for them seem obvious. But studies examining market timing strategies show that attempts to time the market, investors moving money in and out of funds and markets, they just result in negative performance gaps. Research firm Dalbar has been reviewing the data annually for 40 years in their quantitative analysis of investor behavior. The most recent study reveals again that the average equity mutual fund investor consistently underperforms the market return. In this case, as measured by the S&P 500. During 2023, the gap between market and investor was 5.5%. The conclusion is that the average investor, by moving money around based on timing strategies, actually reduces their overall return relative to a strategy of simply staying invested throughout the entire period. In a 2022 study cited in the Wall Street Journal, academics quantified the problems in even greater detail, indicating gaps between investor performance and fund asset classes in up and down years, as well as years with high or low relative volatility. They just wanted to see if investor experiences of risk influenced the outcome. But in every case, there were gaps, with average investors consistently underperforming the funds that they invested in. The general conclusion of all these studies is that investors tend to do worse than available funds because investors move their money in and out of the funds at the wrong time. Market timing as a strategy is a predictable mistake. So 2 other strategies that have a high probability of being predictable mistakes are regularly documented by dimensional fund advisors. The first is the idea of choosing higher cost investments, maybe because we think that we get what we pay for, and a more expensive fund must be a better or more sophisticated fund. The second is choosing a high turnover strategy because we think that a manager who trades a lot will avoid the downs, capture the ups by knowing when to get in and out of specific stocks or sectors. Of course, by now you know where this is going. Over rolling 10-year periods, only 13% of the highest cost funds in the dimensional study survived and outperformed their benchmark, while 34% of the lowest cost funds accomplished that goal. In a similar way, strategies that rely on high turnover, doing more than average amounts of trading, do worse than those who limit trading. Over 10-year periods, the dimensional data study of equity funds show that only 19% of high turnover funds survived and outperformed their benchmark, while 32% of low turnover funds did. The longer the time period measured, the more pronounced the difference. Over 20-year periods, only 10% of the high turnover funds survived and beat their benchmarks, while 31% of the low turnover funds continued to survive and achieve a benchmark-like return. It's interesting that while low cost and low turnover funds had a better chance of meeting or exceeding their benchmark, still less than 1/2 of the funds succeeded according to that standard. This reminds me of Foster Group's third investment principle for success: trust markets. The market is just a tough thing to beat, but it is a relatively easy thing to make into our ally. There's another famously and predictably bad strategy for investing, and that is following your neighbors, coworkers, or golf buddies' can't-miss investment advice that they got from someone who's in the know. While it's hard to get good data on this last one, it's not hard to believe that many of these would make the Darwin Awards if they were given for investment ideas that ended up going down in flames. I was watching a recent interview with Dimensional Fund Advisor's Chief Investment Officer, Gerard O'Reilly. I've met Gerard on numerous occasions, and I can tell you he's a very smart, highly educated, and competent guy. During the interview, Gerard was asked what Dimensional tries to do at a high level to avoid mistakes and achieve good investment returns for clients. After thinking about it for a couple of seconds, Gerard simply said, "Don't do stupid things when you know they're stupid." In other words, avoid predictable mistakes. This may be one of my favorite of our 5 principles to talk about because it allows us to laugh at ourselves a bit. I'm as susceptible as anyone when it comes to believing a good story, and there's a lot of stories out there that are vying for our attention. In the financial industry, people are trying to get your attention by claiming they have found the secret to better returns or eliminating risk and uncertainty. Unfortunately, most of these magical approaches turn out to be yet another version of a predictable mistake. I like to remind investors that educated optimism is an antidote for anxious uncertainty. An optimism which is based on solid education and research really helps investors to resist the temptation to fall into predictable mistakes. Our goal is for these podcasts to contribute to you becoming educated and prepared optimists. If there are topics or questions you'd like us to address, please let us know at our website, www.fostergrp.com, and click on the words Financial Perspectives. And if you're listening to this as a podcast, you can help us spread the message of educated optimism by liking us on your podcast app. As always, thanks for investing some of your time and attention with us today.